Good morning. So I'm sitting here at the house working from home. No, I don't have the flu, but I am dressed for work. It's Premier. I'm on puppy duty. She's asleep right now, so I'm going to use this opportunity to try to get some stuff done. So I thought I would talk about debt ratios and qualifications. So when someone's talking about a debt ratio, what they're talking about is how much money you spend on a monthly basis compared to how much money you make. We're talking about your gross income. If you're self-employed and you get commissions, or things could be different, reach out to me and maybe I'll post something specific to that. It's kind of hard to explain that for a rule of thumb, but if you're W-2'd, wage earner, hourly, salary, take your gross income, and if you are trying to go conventional, 45% of your gross income can go towards monthly payments, including car payments, monthly credit card payments, minimums. We don't use what you pay on your credit card. We know that everybody pays a little extra, but whatever the minimum is, that's what we count against you. Student loan payments, other house payments, those things. If you take your income, your gross income monthly, divide it by 12, so you have your monthly, and then you multiply that number by 45%, see if all of your monthly payments will fit into that. That's a good rule of thumb to qualify on conventional. In recent months, the automated underwriting, which is the Fannie Mae Freddie Mac, anytime we have a file in our system, we have to run it through Fannie Mae or Freddie Mac's automated system to see if it'll approve. And if it approves, then we can move from there and go on to qualify. And it also tells us in the findings what all we have to collect to prove that. But so I don't get sidetracked. What I've found is that conventional is now, when you have a good file, you're putting down money, you have a good credit score, reserves, everything else, the automated underwriting is allowing between 45 and 50% now in conventional. So it's you want to do a good rule of thumb, you have decent credit and you want to know for sure, 45%. So your total new monthly mortgage payment, principal, interest, taxes, and insurance, plus your credit card minimum, plus your car payments, plus your student loans, or whatever else, all that goes into your gross. 45% of your gross, you should be good to go. On FHA, 50%. So rule of thumb's always been 50%. If you can get under 50%, your credit scores are okay, you're good to go. But we're seeing more and more now qualifying between 50 and 55%. So again, we're going to just run it by real quick and easy. You take your gross income. Let's say you make $100,000 a year, and I should know this stuff, but I don't. So I'm going to go ahead and use my calculator. If you got $100,000 divided by 12, that's $8,333 and some change. Going FHA, and I want to find out what 50% of that is. You can multiply it times 50% and divide it by 2. It does the same thing. So I'm dividing it by 2. So that gives me $4,166 and some more change. Okay, what I usually do is just leave that on the calculator and I start subtracting things out. If you got a car payment at $300 minus $300, got a credit card minimum of $50 minus $50, got another car payment of $400 minus $400, and then your new monthly mortgage payment, let's say it's going to be $2,000 minus $2,000 equals, I still have a positive number, $1,416. That means my debt ratio was below 50%. I'm good to go. Not too tough, right? All right. If you have questions, let me know. I'd love to handle your loan processing from beginning to end. We close loans last year, 2017, I closed in the last 3 months. I closed 4 loans in under 20 days. Closed one at 15 and 117 days. FHA, VA, conventional, we do it all. Don't go to your local bank. Go to me. We get it done faster, and your service is better, and it's cost effective. So, thanks for your time. Please share this video. Thanks for watching, and have a good day.